Hi everybody, this is Tor Storley, and I am back with another video. So this is the second video in this series where we are looking at stock screening per Peter Lynch's methodology. And in this particular video, we will look at some of the principles that he followed. So we will introduce those, and I will show you some of the methods that is used for the stock screening tool that we're going to be looking into. So what I want to do now is I just want to go through some of the principles that Peter Lynch used to make his fortunes in the Fidelity Magellan Fund. So you might wonder, who is Peter Lynch? Well, Peter Lynch was an investor. He was an author. He was also a philanthropist. And he's widely regarded as one of the most successful money managers on Wall Street. He had an astonishing 29.2% average annual return based on his principles of investing. So he followed the old school of fundamental investment, meaning their fundamental metrics. We're going to look at some of the results based on his principles of investing. So I want to point out an article that talks about Peter Lynch's investments methods. It's written by the Swedish Wealth Institute. I'll include this link here in the description of this video. But it basically lays it out pretty straightforward, what he was doing in order to have such a success with this Fidelity Magellan Fund. And if you look at some of these paragraphs here, you can see that he was focused on long-term growth, fundamental type of analysis, invest in familiar companies, meaning you should know a little bit about the company you invest in, so you're more familiar with what they're doing. Another thing is that diversification is important, as you can see here. Also, he was aware that the psychology changes over time. People are people. They're going to change their mind on things and so forth. And you want to avoid fear and panic. To predict the market is a futile exercise. Instead, focus on finding solid companies with good fundamentals and hold them for a long term. And keep your discipline, meaning don't get panicky and so forth. Stick around for a while. That will always pay off. From 1977 to 1990, that fund he was managing grew from $18 million to $14 billion. So that tells you a little bit about how successful he was as a money manager. You can read up on this article here. It's a pretty good article, and it will give you some ideas what his principle was all about. And again, I'll include the link to this article in the description of this video. So I created this document here where I'm trying to outline some of those metrics, if you will, that Peter Lynch was using for finding undervalued stocks. And again, we'll get more and more detail into the stock screening methods and the cutoffs and so forth in a little bit. But right now, I just want to outline what he was looking for. So number one for him was this PEG ratio. And this PEG ratio had two flavors. They had dividends, and if they paid it out, that's this PEGY or PEGY ratio. So the only difference between the PEG ratio and this PEGY ratio is this portion of the formula, the addition of dividend yield, which, of course, the dividend yield is when you take the annual dividends per share and you divide it on the price per share, the current price per share. That will give you the dividend yield. So anyways, he used this PEG ratio as a metric to look for, to see if there was some good potential investments to be made. And as you can see here, it's the PE ratio over the earnings per share growth rate. And this earnings per share, we'll look at it in a little more detail because there's two kinds in most larger companies, and we'll look at that in a little bit more. But anyways, there's this PEG and PEGY ratio. And then he had some additional screening criteria he was looking for, like the PE ratio. And he was looking for PE ratios that was below the market. Now, market is kind of broad, so I would say you should really look for PE ratio within the industry you're in. In other words, your peers, who you're competing against. So take some of this with a grain of salt because it's not a fixed thing. It's just ranges. And these are just generic stuff. We'll put our own cutoff points when we get closer to actually creating the stock screening code or the model, if you will. All right, another thing he was looking for, obviously, in the PEGI ratio was the growth rate. Low debt is what he was looking for. And using the capitalization of the company should be more based on the equity. In other words, what they own, not what they owe. Also, institutional ownership was another factor he was looking for. And of course, earnings consistency. You want a consistent track record. So that was some of the things he was looking for. He also categorized some of these stocks that he was looking for into categories. So he had what is called a slow grower, stalwarts, fast growers, and cyclical, and also something called turnarounds. And then he also looked at something called asset plays. Just to go very quickly through this, these are mature companies. These are companies that's most likely pay out dividends because they need a way of attracting investors to their company because they are slow growers. So they might have limited growth prospects. They're typically mature, large companies. That's what they call a slow grower. Then you have moderate growth, like Coca-Cola, for example, those established companies. They're pretty much multi-billion-dollar companies. They have reliable earnings growth. Fast growers are upstarts typically, and they need a lot of cash, and they need to place the cash back into the business as they earn it. They have a lot of startup costs. So it's a very high risk of failure, but their growth potential could be really dramatic too. And you see that often in companies that are on the fringes of the norm, such as technology companies, such as cancer research companies, stuff like that. And suddenly they have some kind of win, and then they start growing really fast, and they attract a lot of investors, etc. But again, they tend to plug all their earnings back into the company and not pay any dividends. Cyclicals go up and down depending on the economy or depending on the type of business they are, like autos, like airlines, steel, chemical, defense contractors. So the sales is kind of yo-yoing up and down. The turnarounds are those that had setbacks in form of maybe they were close to bankruptcy or they had some reorganization and then they came back. Could be cyclical companies that recovers from the downturns, etc. Now, asset plays is when the company sits on something that you can see, but the average investor in the market may not observe. So it could be something valuable that Wall Street doesn't know about. It could be some kind of hidden real estate or patents or something like that. It's hard to pinpoint this, but it's like a hidden value within the company. Okay, so his perfect stock checklist was PEG ratios. And again, we'll get back to these cutoffs. And he liked to invest in companies that were boring, basically. A lot of investors were not interested in boring companies, like, what are you making, bottle caps, that kind of thing. And that doesn't look very glamorous. So he preferred boring, unglamorous industries to invest in. Now, he preferred the institutional ownership to be less than 50%. He preferred companies that buy back their own shares. In accounting terms, that's something called a treasury stock, where you buy back your own shares to reduce the amount of shares out in the marketplace, and therefore your earnings per share will go up, and your number of shares that you divide your earnings on will also go down because you bought back your own shares, so there's less shares outstanding. He preferred strong balance sheet, in other words, very low debt. He preferred high cash balances, meaning you can pay off your debt with no problems because you're sitting on a lot of cash. And he also looked for companies that had a competitive advantage. I also created this document to show you some of the ratios that we're probably going to be looking at in our stock screening model. And again, this PEG or PEGI ratio is the one that was number one in his book to look for. So here you can see the formula for it. Take the PE ratio, divide on the annual earnings per share growth rate. Now, this is a little misleading, and I'll show you an example here, what I'm talking about. If you look at the earnings per share, and if you look at a big company, like a multi-billion-dollar company, we'll get back to this output a little later. I created some code that creates these pro forma financial statements, but I won't discuss it in this video. I will probably make a separate video where we can go through this and how I generate this stuff using Edgar tools and etc. But basically, if you look at it here, the pro forma statement here will tell you 2024 in this case, 2019 over base. What does base mean? Well, this is a balance sheet. There are two numbers here. So total assets, in this case, 135.16 billion. That has to match the other side of the accounting equation, which is total liabilities and stockholders' equity. And you can see those two numbers are the same. Now, that's what we call the base. So whether you pick the total assets or you pick the other one here that I just pointed out, that's up to you. It's the same number. But this represents a vertical pro forma. What that means is you will take the cash balance or cash equivalent and you'll divide it on the total asset number. That will give you a percent. And it's very helpful to look at this year over year because it will tell you how much cash and cash equivalent the company had based on their total assets or total liability plus equity. So in this case, the cash balance for AbbVie in this case is 4%, as you can see. But there's also another way of looking at this. This is called a common size analysis. And a horizontal is called year over year. So if you look at the year over year, that's these columns over here. And what this will tell you is how did the cash and cash equivalents change over the different years. And you can see there's been quite dramatic here. From 2019 to 2020, it dropped by 78%, and then it went up by 15, then it dropped by 5. So the cash seems to be fluctuating quite a bit here for AbbVie. But it will give you an illustration in how accounts or how your balances changes over time. So for a company that's trying to have a low debt or ways of paying off that debt, you want to look for this cash and cash equivalent. And if you don't put the inventory in, because inventory is harder to get rid of than just converting into cash and cash equivalents. So you're looking for strong cash positions like this. And this statement, along with the income statement, which is this one, along with the statement of cash flow, like this one, will kind of give you an idea of how the company is doing. So again, I just wanted to show you this and point out like, hey, here's the cash and cash equivalents. And if you look down here, you can see short-term debt, very little, and you can see decreasing based on the dollar figures. So sometimes you can look at the dollar figures, sometimes you can look at these percentages, but they might look dramatic. But if you look at the actual numbers, you kind of understand what's happening. So that's the strength of this particular format. Earnings per share. If I scroll down towards the end here, notice there's two kinds. There's basic and there is fully diluted or diluted in this case. Now this doesn't change much, but sometimes these numbers might be different. And according to generally accepted accounting principles in the US, you have to report both of them if you have financial instruments that can be converted into common stock, such as convertible bonds, for example. Some kind of preferred stock that can be converted into common stock depending on the contract that is set up. The bottom line is that sometimes they do like the worst case scenario. If they convert everything into common stock from these different financial instruments, then how much will the earnings per share be if it's fully diluted, as it is called? And that will change the earnings, and that will change the number of shares that are outstanding, because suddenly you will convert these preferred shares, for example, or these convertible bonds into more shares. That's how you read this earnings per share. You either use the fully diluted or you use the basic. It depends on how it's reported, okay? According to the book, and this is written in the One Up on Wall Street book that I checked out from the library. According to him, he said, you should be able to do this on a napkin in a diner or in, anywhere you eat breakfast. And you should be able to just to jot it down like a fifth grader would. So it should be very simple. It shouldn't be very complex. And he hated all this complexity of Wall Street and all these analysts, and they go through all the details of everything. Because he said, in the end, things changes all the time, and there's no point. What are you doing all this complex, try to get the exact numbers and so forth? But he was looking at the basics and the overall and using common sense. One thing he says, hey, debt to equity ratio, okay, that deals with your financial health. And that's true for anybody. If I owe a lot of money, where am I going to get the money to pay it off from? Well, I have a few ways I can do that. I can go out there and get a job and earn some money and try to pay it off that way. The point is, how much do you have to pay off? Can you afford it? And that's when he looked at some basic ratios. And again, these are accounting ratios, and you got to be careful with these ratios because they're based on accounting numbers. And they're based on snapshots in time from the balance sheet, etc., income statement. Whatever you saw at the end of the year doesn't mean that's the same thing you look at now in the first quarter or second quarter of the following year. They might have changed. But the bottom line is you got to start somewhere. So if you look at the debt to equity ratio, it's based on your total debt divided on your total shareholders' equity. So what does that mean? Well, another word for that in basic terms is what you owe divided on what you own. So if you own this is what you owe. You don't want to pay more for what you owe from what you have, right? So you want it to be really low debt. You want it to be less than 50% if you can. Now, what is a current ratio? Current ratio is basically that you have your current assets divided on your current liabilities. So what does that mean? Well, typically the word current in accounting terms means within a year or the operating cycle. So in other words, the current assets would be all those things like prepaid expenses, like your cash and cash equivalents, like your inventory, like your accounts receivable. Those are not in cash terms. They're in accruals, meaning you record them as they incur, but you don't necessarily have the cash for it yet. So the current liability is what you owe in the short term within the operating cycle or 1 year, whichever is longer, I should say. You want this obviously to be as high as possible because that means you can cover it many times over. So if it's a 3-to-1, for example, if your current ratio is 3, that means you can cover your short-term liabilities by $3 to 1. So that's a good thing to have, right? The return on equity, what is that? Well, you want to find out how much is your company generating from your shareholders' equity in profits. So it's the profits from shareholder equity investment, meaning what you own, not what you owe. And again, you can read this on your own. I'm not going to dwell on it. The profit margins, what is that? Well, that's your net income on your income statement divided on your total revenues, and that will give you your profit margin. So it just shows you how much each sales dollar becomes net profit. Remember, when you sell something, you still have cost of goods sold. You still have to pay to produce whatever you're selling. So that could be expensive. You also might have to pay your administrative costs, such as salespeople, such as renting places to run your business out of, etc. And those are called selling and administrative expenses. And therefore, you want to make sure that you have a lot left over after everything is paid, and that's your net income, and that goes into your retained earnings over time. Now, growth. Growth is a tricky one because it's very hard to measure. How much have you grown? But you're looking for the year-over-year percentage increase in your earnings per share. So this one is basically taking this year's earnings per share minus last year's earnings per share, divide on last year's earnings per share. And I just showed you that right here. This is the earnings per share from 1 year to the next, right? Starting in 2019, which is here, 2020, 2021, etc. But you can also see it over here, how much it has grown year over year. And that's what that formula is showing you. But this is for a different company. This is for AbbVie. So just be aware of that. Anyways, you can read up on this on your own. I'll make this stuff available for you out on GitHub. Now, pro forma, we already looked at, so I'm not going to spend time on this. But what is the revenue growth? Well, that's your current revenue minus your previous revenue divided on your previous revenue. Again, use your pro forma here, and you should be able to find this very quickly. Go to the income statement, go to revenue, and start looking at year-over-year revenue growth. From 37.69 to 22, that goes down. Actually, it went up by 22. You can see the numbers over here, 33 to 45 to 56. So that means it went up. It went down in 2023, but not by a lot, a little bit. And then it went up again. So yeah, you can tell by looking at the numbers and the percentages. Return on assets, you can take your net income, divide on your total assets. Now this goes across two different statements. So if you look here, you can see net income. In your pro forma, you can find the net income at the bottom, right before the earnings per share, most likely. So if you look here, you can see here's your net income, these numbers, and the percentages here, year over year. But you have to divide it on the total assets. So when you look here and you run up the list here and you see total assets. Here's the total assets for those years. So you divide on that and you get a number, you get a ratio, right? If you have a return on asset of 5%, that means that the company earns 5 cents for every $1 of assets. Here is a price to book. The book value is an accounting number. You're going to take the market value per share, which is the current price per share, and you could divide on the book value per share. So you can look here, what is the book value per share? Well, it's the total equity minus the preferred equity if you have any preferred stock. And you divide it on the total shares outstanding. So in other words, it's an accounting number. When you take the actual market number and you divide it on the accounting number, then you'll get this price to book. Price to sales, what is that? Well, you take the company's total market capitalization and you divide on the total revenue. And again, it shows you how much an investor is willing to pay for each dollar of sales. So that's what that one is doing. Dividend yield, it's simply the annual dividends per share divided on the price per share. So here is just some overall scoring weights. The PEG ratio obviously was the most important. Now, I'm not guaranteeing you that this is what he used as a cutoff, but I'm just using this here because we're going to tie it in to our model when we create it. Financial health, how much debt you have, etc., how you can pay for it. What about the growth? Is the company growing well and not? Value, the price to book, the price to sale, that kind of stuff. So that's what the value proposition is within this scoring system. So finally then, here is some cutoff points, and we'll look at that in more detail when we get to it. I just listed it here. It's based on the book that I checked out from the library, and it's based on me consulting back and forth with Claude Sonnet 4.5 and coming up with some ideas. So that's how I came up with all this information. But again, don't ever trust a large language model because they hallucinate quite a bit. And unless you double check everything. So again, I just warn you about using LLMs. Okay, so we looked at the undervalued stock screening. We looked at the ratios. And in the next video, we're going to get into how we're going to actually create this stock screening model, what kind of program we're going to use. And I'm not going to use Python, just so you know. Okay, I think we leave it at that. I hope you liked this video. And if you do, please give me a like and consider subscribing to my channel. It'd be fantastic. We'll see you in the next video. Thank you so much.